Good morning, good afternoon, good evening, folks. It is Monday, and that means we bring on a wonderful guest, Mr. Greg Dickerson. How you doing this morning, sir? How you doing, Greg?
I'm doing great. We've got internet trouble here, so bear with us today if you need to fast forward through, but we're freezing in and out, so just hang in there with us.
Yeah, we will get it done together. I am paying for a much higher internet at the end of the day. 1 o'clock today, Comcast comes in and AT&T goes out. So I'm really excited about that. Let's fingers crossed. So Greg, one of the things I wanted to talk about today is this weekend I completed 50 years of research into housing, 1970 to 2020. And one of the things that jumped out at me is that rising interest rates, significantly rising interest rates, did not produce a housing crash. And I thought that was interesting. I wanted to talk to you about it. One of the things that you and I have talked about is if interest rates get to 4, 5, or 6, both of us think housing is going to slow down. We may have even thought it caused a bubble to be pricked. But I want to show you some data, and let's just talk about it. You ready?
I'm ready. Let's look at it.
All right. So let's share this screen. All right. So let's move our pictures out of the way. We'll just collapse so I see you. So are you seeing this, hopefully?
Yeah.
All right. So what I've done is we'll just give you a lay of the land because this is the first time you're seeing it. So what I've done since 1970 is I've captured different variables: home ownership rate, median price. I've calculated home appreciation, which is just math, right? The year prior versus this year.
Is this the same chart we went over last week, or is this different?
It is a little bit different. So this is every year. The last time we did it was every 5 years, which missed big periods.
Okay.
And last time we only went back to 1980. Now I've gone all the way back to 1970. So more variables. Make sense?
Yeah.
Okay, so other than that, it's the same thing, but I've added wage growth, which I did not have last time, and I've done home appreciation. So what I thought was interesting and where I wanted to talk to you was right in here, 1978 to say 1981. You see the highlight? I just want to see how fast the internet is today. You seen this?
Yeah.
So what we have is an interest rate starting at 9.6%, which is just nutty when we're at below 3. But what you see is you can see interest rates go all the way up 4 years in a row to 16.6%. Even though that happened, look at appreciation. Home appreciation was still going up and actually never went down. That surprised me. You see that?
Yeah, I see it. Go ahead. You're breaking in and out, but I see it.
Yeah. So a couple of things jumped out at me is, again, what we see here below is something, again, I didn't calculate last time, but because interest rates went up and values went up, housing got unaffordable. These numbers here in red are unaffordable. You're getting a no answer from a bank if your mortgage payment is 40% of your gross take-home pay. So even though interest rates went up, values went up, housing payments are unaffordable, values in real estate still went up. That surprised me.
Yeah. So that time frame is an outlier. So if you remember back then, that was when there was a big push for home ownership. There was a huge campaign because that was a deflationary period where we were having some issues. If you remember that late 70s, early 80s. So one of the solutions was to really push home ownership. So you had a lot of people where, it was a little easier to borrow money. I think that's when did the 30-year mortgage come out? Wasn't it around that time frame?
I think it was much earlier. I think it was in the late 60s, actually, but I could be wrong.
Late 60s, yeah.
Maybe it became common. Maybe it became a lot more common in the 80s, but yeah.
Yeah, it might have been. And then, we bought our first house, it was 1990, so it wasn't through the 80s. But, I think there was a big push on home ownership back then. And I also remember, so there was a time, so even though values were going up and interest rates and all that, it was still a difficult time for housing. My parents, I remember they sold a house that we lived in Florida, where I grew up in Pensacola, Florida, and they had to sell it with owner financing because they couldn't sell that house.
Exactly.
It was a tough time. So they had to give the buyers a second, they had to take back a second mortgage to get that house sold.
Well, that's exactly where I go in this environment. Again, when I built this data, I had no idea what I was going to find. So again, what was surprising to me is mortgage rates go up, housing values still did, but housing became unaffordable. So what I think happens if interest rates go up now is transactions fall off a cliff. Housing transactions fall off a cliff. Builders have problems selling homes. And oh, by the way, as you just said, creative financing takes over.
Yeah, and values, so it's very different now, very
Okay.
different. So back then, so you got to understand, back then it was all about building wealth. So housing was the great wealth building savings plan pitched to the American, to Americans. It was the great American dream, home ownership. That's how you build wealth. And when you look at the values back then to now, it was a great plan. So it was a very different mindset. People weren't buying payments back then. They were buying wealth. That was something, and my parents are a great example. They traded up into a bigger and better house each time, and their ultimate wealth that they built over the course of their lives was built through their houses.
Yeah.
Their parents, my parents. Nowadays, people are buying payments. It's a whole different mindset, whole different affordability of housing. And it's been really that way since the speculation, the great speculation of the, mid 2000s to late 2000s until the correction.
Yeah. Yeah, there's a couple other things that jump out at me at this time frame is wages, right? Another thing that wasn't in my search last time is, okay, yeah, home appreciation's up, which we've highlighted here, but look down below, wage growth. Wages went up 20% in 1978 and 79 combined, right? And they continue pretty high in 80 and 81, right? They're up actually, so what is it? It's 34%, something like that. What is that?
Yeah.
35 point, whatever, 6 total. Yeah. So again, wages went up, and it's interesting. So housing became unaffordable, creative financing, a la your parents had to do a second, exactly what happened in the early 80s. And then what you see up here, because housing became unaffordable, is home ownership fell off a cliff. The lowest home ownership we had in the last 50 years was in 1988 and 1986 at 63.8%. So again, it kind of all ties together, right? Payments on houses or payments become unaffordable, then homeownership goes down just like you would expect, a la George Bush comes out and wants to push homeownership again. And then we just keep moving forward. And we have the peak in housing ownership at 69% in 2004. Lo and behold, we have the Great Recession. Look at this, wage growth falls. We have negative wage growth in 06, 07. And then we have housing finally cracking, because again, people don't realize housing crashes don't occur in a year. There's a big lag. So we had 5 years of negative housing growth long after the Great Recession, right? The Great Recession was 05, 06, but values kept falling for 5 years. Pretty crazy.
Well, the actual event was 08, 09.
Okay.
The peak of the housing market was 05, 06.
Right. Housing was 05, 06. Yeah.
04, 05, 06, depending on where you were in the country.
Yeah. And then what you have is you start having, because again, the housing is cheaper, rates are crashing, right? Housing is cheaper in 2012 than it was in 08 by 35 grand. Crazy. And you have rates from 6 to 3%. Look at this. Housing is never more affordable down here in green. Right? Housing has never been more affordable than the last 8 years. Because again, it's all interest rates, right? Interest rates now are, nearly 3% in 2020. So lots of great data in here. People are buying payments. At least in 2020, it was never more affordable, 15.9%. Pretty crazy.
Yeah, that's kind of how it's been for a while. It's all about that payment. And I tell you, the other thing, when you look at inflation numbers and things like that, a lot of what these reads aren't including are rent. It's not including rent in the inflation numbers.
Yeah.
It's not including, housing, a lot of things like that, house prices, inflation. I mean, that's not part of the CPI index. And we're going to start seeing some of these numbers baked into the reads here as we move forward. So it's really interesting.
Yeah, that's what I'm telling people is I think so first off, a couple of things that I wrapped up this section. I think wage inflation is happening like never before, except maybe 1976 and 77, right? There was a 2-year period where wages went up 20%. I think we are looking at big wage growth today, which is great for those folks, or for all of us. Although you got to remember, when wages go up, there is a trickle down effect, and that's what we just saw in the 50 years. So it's going to be pretty interesting times. But I was shocked. Interest rates went up 8%, 800 basis points, and housing values never cracked. I bet you transactions fell off a cliff, but values didn't, and that surprised me.
You know, there was a lot going on in that time. Like what the housing stock looked game back then.
Yeah.